Money is changing hands at the fastest rate we've ever seen in history. In 2020 and 2021, we saw a huge growth in wealth by the top 1%, the 0.1%, and the 0.01%, and this quick concentration of wealth ignited the fuels of a wealth tax idea to redistribute this new money. Now here we are in 2023 and we're seeing the opposite happen. We are seeing the wealthiest Americans lose their wealth at some of the fastest rates we've ever seen, and states are still pushing for a wealth tax to redistribute this wealth. The question is, where is all this money and wealth flowing to, and how can you get your share? To really understand this, let's take a step back and understand how wealthy people's wealth grew so fast in the first place. The best way to understand this is just to think of Chipotle. You have three types of people who transact with Chipotle. You have the people that eat at Chipotle, you have the people that work at Chipotle, and then you have the people that own Chipotle. These are the shareholders of the Chipotle stock. When the pandemic hit in 2020, our economy was shut down, and then the government pumped up our economy with trillions and trillions of dollars of stimulus. And then people got this free money and they started spending it. People bought double meat and extra guac in Chipotle, and this made the owners of Chipotle rich. Our economy runs on spending. The more money you spend, the more money somebody else makes. So if you go from cooking at home to then going to Chipotle and ordering there, to then getting the double guac and the extra meat at Chipotle, well, the more you spend at Chipotle, the more money the shareholders or owners at Chipotle make, because now Chipotle is making bigger profits, so their stock price goes up. So when people talk about Elon Musk making over $100 billion during the pandemic, this wasn't $100 billion that he saw hit his bank account. This was in net worth, because the value of his Tesla stock went up. This is where things start to get a lot more fun. So now we understand that rich people got richer because the value of their assets went up. But what happens then when the value of your investments, your stocks, and your real estate go down? Where does that money and wealth go? Think of it like this. You bought this home in 2019 for $350,000, and it was in a good area. Then by 2022, because of the housing market boom, you saw your home price grow to $600,000. This was the fair market value in 2022, because a neighbor on your left who has an identical home, they sold their home for 600 grand. Your neighbor on the right who also has an identical home, they sold their home for $605,000. So you can comfortably assume that your home is worth $600,000. Now you might feel richer because you bought this home for $350,000, now it's worth $600,000, but this isn't money that you have in your bank account. The only way that you can realize this cash, this new wealth, is if you A, sell your home, but then you're not going to have a home anymore, because if you sell it, now you'll have this cash in your pocket, or B, if you do a cash out refinance, because now you can pull out this equity from your home with a mortgage, but then you're going to have a bigger debt payment. This is what we saw some people do. Some people were able to capitalize on their newfound wealth by selling some of their investments or pulling cash out of their investments by going into debt. That way there was more cash entering the economy, because now in this situation, if you were to go to the bank and borrow $550,000, now there's more money being printed, because banks don't just have this cash laying around. This money gets printed, more money enters the economy, and now you can go and spend this $550,000. But the problem with spending money based off your net worth is that this is just invisible wealth. It's invisible money, and it can be taken away in an instant. Like now in this situation, let's say you put your home on sale for $600,000, but you don't get any offers. And then you realize, oh no, I thought my home was worth $600,000. I was spending money as if I was worth $600,000. But I'm really not. And that's exactly what we saw happen. When the economy decided to slow down in 2022 into 2023, the overinflated valuation started to come back down to earth, which meant that this newfound riches also fell back down to earth. So if your home price, the fair market value, goes down to $350,000, that's the most that somebody's willing to pay for your home, where did all this money go? Well, it depends on what you did when your home went up in value to $600,000. If you just sat there and you looked at Zillow and you said, oh, my home is worth $600,000 now, that's nice, and you continue to live your life like normal, and then home prices went down to $350,000, no money was gained, no money was lost. It was just invisible money that on paper you were worth more and now you're worth less, but nothing actually changed. It starts to change though if you did something when your home was worth $600,000. If you sold at $600,000, well, now you had this cash in your pocket, and then you sold your home to somebody else at the peak. Somebody bought this asset for $600,000, now it's worth $350,000. Or if you did a cash out refinance, that means that now you took money out of this home with the help of the bank. You took out $550,000 and then you spent this money. Maybe you bought a boat, maybe you bought on a vacation, maybe you went on to some nice restaurants and you spent this money. Those are the places that made money because of your newfound wealth. And now that your home is worth this, well, everybody else got rich at your expense because you financed this asset which isn't worth enough to cover this debt. Now you are the one that's paying the price, and you are the one that lost this value because you actually pulled the cash out and gave it to somebody else. And now this asset isn't worth as much as you thought. If you were to sell it, well, now you're going to owe a lot of money to the bank, or you'll be sitting underwater on your assets, making payments to something that's worth less than the amount of debt that you owe. So if this newfound invisible wealth was never made visible, meaning the asset owner, the stock owner, the real estate owner never sold their investment, or they never pulled cash out of their investment through a cash out refi or through debt, then no wealth was actually gained and no wealth was actually lost when the value of this goes down. However, what some people did was they either sold or they pulled cash out, which meant this wealth was actually realized. If you sold, you got to pay taxes. If you pull cash out through debt, you don't got to pay taxes. But now this cash went from invisible to visible, because it's invisible because it's just in your net worth. It's visible when it's cash in your hand. And then when this cash became visible, now you can go out and spend it. The people who got this new spending became wealthier because now this money was spent. But now when the asset value drops, now if you sold it, you're okay because you realize the cash, you no longer have this undervalued asset. But if you pulled cash out through debt, now you're underwater on your asset, and that cash that you spent is gone. The people you spent this money to, the boat owner, the restaurants, the vacations, they got wealthier because you spent money there. But now you're underwater on the asset that you used to finance these expenses. And now the question is, why is this happening? Because if you look at VC investments, venture capital investments were skyrocketing in 2021, and then they started cratering back down to earth in 2022 and even into 2023. Venture capital is essentially institutions that are investing their money into business ideas. And what we saw was in 2020 and 2021, we saw more money than ever flow into new business ideas. And then in 2022 and 2023, this money that was flowing into business ideas came crashing down to earth. And this had a huge impact on valuations, because when you have more buyers than sellers, the price of something goes up. When you have more sellers than buyers, the price of something goes down. So when you had all these venture capital firms that were sitting on huge piles of cash, that were throwing money at businesses, well, now businesses were able to claim much higher valuations. They were able to ask for way more money. They were able to say that they were worth way more money because there was so much money floating around, and venture capital firms were looking for places to put their money. And so then venture capital firms are competing with one another, kind of like two buyers competing to buy a home. So now they were outbidding one another, meaning giving more money to businesses and offering higher valuations for businesses, which made people's net worth go higher, because now valuations of assets across the board were skyrocketing because there was so much money floating around. Well, then came 2022, and then interest rates started to go up, which meant venture capital firms and investors needed a higher rate of return, because they were borrowing money to make these investments. And so when now you have to borrow money at a higher interest rate, you now need a higher return on your money in order to justify making an investment. If I can borrow money for 2%, I only need a 4% return on my investment to make it a very great return. But if I have to borrow money at 7%, now I need at least a 10% return on my money for it to justify being a good investment. So now the venture capital firms, the investors, they're being much more pickier because they have to get a higher rate of return. And so that means less buyers, less people putting their money into investments, which meant less demand while the supply was still there, which pushed valuations lower. Now all of a sudden you had all these entrepreneurs, all these business owners, all these companies with super inflated valuations that nobody wanted to pay the price for, which made these valuations come back to earth. We saw it happen with startups. We saw it happen with venture capital early stage companies. We saw it happen with tech stocks, and we're seeing it happen with other sectors on the stock market as well. And now we're starting to see it happen with real estate, where real estate prices are coming back down. It all comes back to supply and demand. When you have more buyers than sellers, the price of the asset goes up. When you have more sellers than buyers, the price of the asset goes down. And what we've been seeing happen is there's less demand. Buyers are starting to go away because they're being pickier on prices, because they're looking at the valuations of some of these assets and they're saying, it's too high, which has been causing the price of some of these valuations to come back down to earth. And the reason, well, it goes back to interest rates, because higher interest rates demand higher returns. And if companies cannot deliver these higher returns, then investors don't want to come in and buy. These are the things that we're covering in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, it's a super simple read. You can read it in less than 5 minutes every morning. My team is breaking down all the things you need to know with what's happening in the financial markets. It's a fun, witty, and easy to read email. So if you want to join Market Briefs, it's completely free. And I'll put the link to how you can join down in the description below. This is the way that our system works because the thinkers, the C-level executives, have a fiduciary duty to increase the share value of their corporation. AKA, the C-level executives have a duty to increase the stock price. Who does that benefit? It doesn't benefit the workers unless you're taking a piece of your paycheck